Should Indians invest in China? After India outperforming China by a huge margin over the past 5 to 6 years, China has leapt back as a force over the past 2 to 3 months, especially since the launch of DeepSeek by a Chinese company, a low-cost AI that can compete with the AI giants of the US. Should Indians pick up Chinese stocks at beaten down valuations? Ruchir Sharma, in a recent column at the Financial Times, asked the question, is China investable again? He argues that China was always investable, but at a price. He says that China has more than 250 companies with a market cap of over $1 billion and a free cash flow yield of 10%. The US, by contrast, has just 150. He adds that except for 20, most of these are not tech companies. They are in sectors like industrials and consumer discretionary. Donald Trump has also been softer on China and Russia than was initially perceived. There is no doubt that China is cheap. The Hong Kong-based Hang Seng Index that tracks many Chinese companies is still below the 2007 peak. The trailing and forward PE of the MSCI China Index as of 31st Jan are 13 and 10 respectively. You can contrast this with the Nifty trailing PE, which is at 20, and mid and small cap valuations that are arguably a lot higher. Now, Indian companies are growing their earnings faster, but how long can this premium continue? China has already seen a bounce back, but nowhere close to closing that underperformance gap with India. The Hang Seng Bees, an ETF operated by Nippon India Mutual Fund, which tracks China, is up almost 70% over the past year. What about arbitrary Chinese government actions, like the ones it took against tech companies or private companies over the past few years? Or the collapse in real estate and slowdown in China's economy? These are all valid concerns that have held back China. But if you accept these risks, there are some ways to take exposure. First, there are domestic ETFs like Hang Seng Bees or the Mirai Hang Seng Tech ETF. Or there are actively managed funds like the Edelweiss Greater China Equity Offshore Fund. These ETFs, however, trade at a huge premium to NAV. So please check the iNAV carefully before you invest. The iNAV is available on the NSE website or it's available on the fund website. And the reason why this premium exists, why the traded price is so much more than the NAV, is because RBI has stopped Indian mutual funds from investing more outside India. And when people buy these ETFs in the secondary market, essentially they are paying a higher cost. Now, if you don't want to pay a 10% or more premium, open a broking account in the US and buy China ETFs there. For example, there is the iShares MSCI China ETF or MCHI.